The buy side of the curve within a market maker sell model. This right here is the market maker sell model. This is basically a visual representation of how the algorithm delivers lower prices. The market consolidates somewhere, then we see buy side delivery, so the market is trading higher into an area that we can look for this reversal to take place. So the market reverses here. This is called the smart money reversal, and then we see lower prices get delivered. This is the buy side of the curve, buy side delivery. This is the sell side of the curve, sell side delivery. In this video, we're going to focus on the buy side of the curve. This red box is basically the area where the smart money reversal takes place. The buy side of the curve usually has 1 or 2 accumulation phases, or maybe even 3. So what happens is that the market consolidates here somewhere and then it starts to expand higher. We see a first retracement, we see a second retracement, we see a third retracement, and then we see the market trade into our point of interest, our premium array, in which we look for a smart money reversal to take place. Why do we look for the smart money reversal to take place? Well, if you look at this and you imagine that a retail minded trader looks at this and he sees that the market is trading higher, and he believes that these are all support levels, you need to understand that sell side liquidity rests below each low. Why? Well, retail will place their stop losses below these lows because the books teach us that, okay, the market reversed here, so that means that is a support level. So the next time when the market returns to this level, it will find support there and then continue higher. So what retail does is that, or what they think at least, is that when this support level gets broken, their idea gets invalidated. So they need to place their stop losses below these lows. If you remember the liquidity video, the liquidity lecture, you see a liquidity trend line here as well, a liquid trend line phantom. From this low to that low, you can draw a diagonal trend line, and that's a low resistance liquidity run. We'll get into more of these things in depth later on, but for now it's just important to understand that the buy side of the curve here sets up the whole sell side delivery that will follow. Based on this side of the curve, so the buy side of the curve, you know where your shorts will form. Soon you'll know why. The buy side of the curve can also just be one accumulation phase and then one big green candle up and then the reversal and then the sell side of the curve. When this happens, you can already tell based on the left side of the chart, so the buy side delivery, that the right side of the chart will be very aggressive. Why? Well, if we go back a few slides, or one slide, you need to understand that every time that a low gets purged, so one of these important support levels, so to say, gets taken out, the market retraces. So it retraces and then a smart money gets the opportunity to enter short and then sell off. But if there aren't many lows, like in this example, so there's just one huge low and the rest of the chart is just pure expansion, that means that there is no liquidity within this whole price range until this low. So when the smart money reversal takes place, it doesn't make sense for the algorithm to have big retracements in here, because it can just be one retracement, give smart money the opportunity to go short, boom. Target this row right here. So what occurs is that when the buy side of the buy side delivery is so aggressive, the sell side of the curve will also be very aggressive, because the only real liquidity pool is below this row from the buy side delivery. Of course, you have the original consolidation, but I'm just talking about the buy side delivery for now. If, for example, there's one big imbalance in here between this price point and this price point, there's no real liquidity pools that can be grabbed or can be targeted or can be swept in order to provide new liquidity for new retracements and then sell off lower. The sell side of the curve will just be maybe one retracement or a maximum of two retracements, 1, 2, sell off, and not 1, 2, 3, 4, 5, 6, etc. Because this is support, like I said, this is the only real liquidity pool here. So the algorithm will try to target this row without providing any real huge retracements. Examples of this will be shown in the complete market maker sell video, because it's hard to only show an example of the buy side delivery and just ignore the sell side delivery, because that's what makes a market maker sell model.